Accounting equation and Excel. Month 1 financial statements. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. We are in Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our crunching numbers is my cardio product line. Now, I'm not saying that subscribing to this channel, crunching numbers with us, will make you thin, fit, and healthy or anything. However, it does seem like it worked for her. Just saying. So, subscribe, hit the bell thing, and buy some merchandise so you can make the world a better place by sharing your accounting instruction exercise routine. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. Well, if you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 3 tabs down below: example, practice, blank. Example, in essence, the answer key. Practice tab, having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab, the one we will be working on, is where we started with a blank worksheet, but we'll basically be continuing with a template. However, we will be adding to the template as needed as we go, practicing our Excel formatting tools as we do so. Let's go to the example tab to get an idea of what we will be doing. Thus far, we've been building our financial or bookkeeping system based on the accounting equation. The accounting equation acting as, in essence, our trial balance from which, at this point in time, we can build our major financial statements reports from, that being the balance sheet, the income statement sometimes called the profit and loss. So we pulled in the beginning balances that we imagined were in the prior accounting system that we had started into our new system here. We entered some of the startup cost type journal entries, the journal entries to get cash in the business, such as deposits from the owner or loans being taken out, so that we have the resources to then invest in the things to help generate revenue, those investments being assets of property, plant, and equipment, and possibly inventory, depending on the industry. And then we went through 1 month of basically data input. So what we have now then is our accounting equation with the accounts under it and broken this out, which is basically like our trial balance. And you can see it's basically in a balance sheet format already because that's what the accounting equation is. However, we've got some formatting stuff that we would like to do to convert this from an accounting equation to a formal financial statement, where we now have not just the balance sheet accounts, but the timing accounts of the income statements, which are part of equity. We can think of them as part of equity, but will be reported differently on the balance sheet summarizing this information, than on the income statement, which breaks out the timing of the period that we're working on, in this case, 1 month. So we want to be able to get this information and convert it as easily as possible so that when we go on over to the right side over here, we're going to construct our financial statements from it. So I'd like to take those numbers, put it into a vertical format like this, so that I can then format my financial statements, the balance sheet here, assets, liabilities, equity, the income statement, and then we're also going to be adding the statement of equity, which helps us to tie together the equity from the prior period to the equity of the current period. We'll work on formatting as we do this, see how the, in essence, accounting equation or trial balance ties into the financial statements. And we'll also get some ideas of best practices on how the financial statements fit together and possibly problems that you might see in practice with the financial statements not fitting together, such as the statement of equity often being a problem because especially small businesses don't always properly close out their books and the prior year, which means that you end up with a problem with the beginning balance in the statement of equity, which we might touch in on as we go. All right, let's go to the blank tab over here. We're going to go all the way to the right, and we're going to build our financial statements. Now, we started our financial statements before. I'm going to scroll up to the top, and we're going to go to the right over here. And so way over here, we started our financial statements. Now, I built something beside it. So we had our financial statements are in cell CT or column CT to CZ. And then I kept building on the right-hand side of it. I'd kind of like my financial statements to be the things furthest to the right. So first, I'd like to move this stuff all the way to the right so we have enough information to just format our financial statements. What I'm going to do is just cut and paste these cells. So this is from CQ, the trial balance in essence that we used, over to here, and I'm going to pick up the skinny as well. So I'm going to pick up the skinny to the end of my financial statement report. Right click, I'm going to cut them so that I move the formulas, not copy, but cutting. And then I'm going to move this to the right. I'm going to put it in DW column, and I'm going to click on the top cell, right click, and paste it. And so that should paste the skinny and all the information. Then I'm just going to go back on over and delete the cells that we don't need now. So I want to keep that skinny. So I'm going to go from here over to here and delete that so we can close the space, close the gap. So we'll delete that information, and there we have it. All right. So now we can go to the right, and we have more information over here to populate. So notice that we have our trial balance here that we did last time when we first started this process, but our trial balance is going to be larger now, so we're going to have to adjust these accounts. These accounts are already being used to populate part of the balance sheet. So part of the question here is just going to be, how can I do this as easily as possible? Pulling in my new balances, adjusting in essence like my trial balance or the vertical format of my accounting equation, so that I can then create the financial statement reports from it. All right, so let's see if we can play with that. I'm going to hide some cells because I don't need all of this stuff. I'm just going to hide the cells to where we get to our accounting equation. So I'm going to go from column D, whatever that is, all the way over and hide all the subledgers. So we don't need all these subledgers. And so don't delete them. We're just going to hide them. Right click and hide those items. Okay. And then I'm going to go all the way to the right, and I'm going to unfreeze the panes. So I'm going to go to the view tab. I have my panes currently frozen. I want to unfreeze them so the headers don't fall down as we go. And then what I'm going to do is I'm going to copy the accounting equation, paste it down, and then convert it so that I'm pasting it in a vertical format as opposed to a horizontal one. So I'm going to copy this whole thing. Going to go from here to here, copy that. And then I want to paste it over here in a horizontal format. So I'm going to put it like on this side for now. Right click and paste it, just the values only. And then I want to copy the last numbers that tie out to that, the end of the month of activity. So that was down here. My last balance was down here. There's my last balance. I'm going to copy the ending balances all the way across, and that should tie out to the accounts. So I'm going to copy that, go back on over here, and I'm going to paste that 1, 2, 3. So now we've got just not the formulas, by the way, just 1, 2, 3. So now we've got our information in a horizontal format, and I would like to convert it to a vertical format. Now, for now, I just want to adjust this information over here and then get back to my financials. So what I'm going to do is I'm going to hide the financials for now to just focus on adjusting my basically trial balance. I'm going to select from here to here, right click. Oh, wait a sec. Okay, paso. Right click and hide. All right. Now I'm going to convert this to a vertical format. So I'm going to select from here to here, copy, And then I'm going to paste it like down here somewhere, but right click and paste it special so that I can transpose it. So transposing it makes it vertical. And so then I'll make this a little wider. I'll do the same thing for this one. I'm going to copy this and then I'm going to paste it down here. Right click, paste it special and transpose it. Transpose, boom. Now it's vertical. So now all my accounts line up in like a trial balance format. Now I'm going to delete all of this stuff. Don't need this anymore. And let's pull this bit up a bit so it's next to it. And now I'm just going to adjust the numbers I already have here. The reason I want to do this, I don't want to just use these numbers. I could just pull this over and reformat it. Maybe that would actually be the easiest thing to do. But the other way I can, let's do it that way. I think that might actually be easier. So if I say this is going to be my, all of this information or my assets. So from here to here, property, plant, and equipment, short-term investment, I'm going to say our current assets. And I will right click and we'll make that green, dark green, and then white. And then I'll borderize it. And then these, well, I didn't put, that's not the right border. Come on. I need a full border, the grid lines. That's what I want. And then we'll say these are going to be light green. They're still assets, but they're the property, plants, and equipment and grid lines. And then the equals shows me that below that is going to be my liability. So now we've got the credit card down here. I'll make this red. And so we'll say red and brackets. And then we have the equity. So by the way, this loan payable, I'm going to make this long term again. So let's make this the dark red. So I'll make this dark red and white. And then the loan payable, I'll make it the light red and the black text because I'm going to make that a long-term liability. And then the owner's equity down to here, I'm going to make it dark blue and white. Oh, wait a sec, not that. Dark blue and white. All right. And then these are going to be light blue. This is the income statement. So this is going to be light blue. Which one? Like this one and white. I think that actually that's too light of the blue. Let's make it this blue. Okay, that's better. Mucho mejor. All right, and then I'm just going to drag this on top of it, which will, let's put grid lines around it. Now, when I drag this on top of it, it's going to mess up all the formulas in my accounting statement that have these numbers tied into it. But that's okay because that'll tell me that it's a reference that I have to fix. So I'm going to pull this. I'm just going to drag it on top here. And that's kind of like my trial balance now. So there's already data. That's okay. Copy it over the top. All right. Now, if I was to double check my accounting equation, the sum of the assets should equal the sum of the liabilities and equity, including the income statement. So we're in balance here. So we're in balance. That's basically like a kind of like the debits and credits in essence, right? These two are in balance. Assets are kind of like the debits and liabilities, and equity are kind of credits. But we're going to do it with this format. So there we have it. And so now I'm going to unhide. I'm going to go from DN to DW, right click and unhide. So here's the financial statements we made before. And I'm just going to copy the formatting of it now where we've got the assets up top, then current assets. I already have the formula that we did in a prior presentation. So now I just need to reallocate the accounts to current assets, which are here to here, property, plant, and equipment, which are here to here, current liabilities here to here now, and the equity section over here. So now I'm just going to say, all right, I'm already formatted current assets. I'm going to say this equals the cash. And then I'm going to say this equals this. but I need 1, 2, 3, 4, 5. So if I go down to here, if I copy this down, then I still I need 2 more cells. So what I'm going to do is I'm just going to select this whole bit below it, drag it down 2 more, and then I'll just copy this down, 2 more down, 2 more down, and that goes down to here. So that looks good. Let's put an underline under here, and then I got to fix my subtotal. So the subtotal of total current assets now is stopping at inventory. I'm just going to drag that down to here. So now I'm at 137, 196. I can double check that by just selecting these, and you should have like a sum function that'll kind of do it for you in the bottom right here, 137, 196. And then we have the property, plant, and equipment, which I'm just going to say is equal to this. Accumulated depreciation is here, which I could say like less accumulated depreciation, but I'll just keep it there. 98,000. And then this, I think I changed the sign to be negative of that number because then I subtracted here. This is always the account you have to be careful of because quite commonly people have it go the wrong way, adding these two up instead of subtracting them because it's a contra asset account, which messes people up. So the book value of the property, plant, and equipment, 90,500, and the total assets, therefore, in the outer column is the 227,696. Now I can double check that on my trial balance by just selecting these items and summing it up to 227,696. Notice even if I had debits and credits, I would make the credits negative because it's a contra asset. I would make all the credits negative, and that would still allow me to sum this up nice and easily in Excel with one column instead of taking the debits minus the credits, right? And then I'm going to go over here and say the liabilities are going to be equal to the accounts payable and accounts payable. Nothing there. I'll copy this down. But boom. But I need, so that I need 2 more. I need 2 more. I need room for 2 more. So I'm going to select this whole thing, drag it down 2 cells, and then copy this down 2 more down. Underline here, home tab font group underline, double clicking the total current liabilities, dragging down from 1,000 down to pick them all up gives me the 5373, which should be the same if I select these, 5373. Long-term liabilities are going to equal the loan payable, and that's going to be, I'm just going to say the 72. Now, we might need to break out a short-term and long-term portion of that loan if there's our installment payments. We'll take a look at that more when we get into the idea of when we get into the adjusting entries. Now, here's the confusing bit. The equity you could have multiple things. So let's pull in all the equity accounts, even though one is 0. So we've got, well, let's just actually, well, we have draws. Let's just call it equity here. I'll call it equity. Just call it owner's equity. Owner's equity. And then I'm going to say that's going to be, this is the error that would often be made, right? They're going to say equals the sum of these 3. Now, the reason that's an error is because this whole income statement is part of equity. It's the stuff that should be in the rolled into owner's equity, which for a corporation would be equivalent to retained earnings, the account that we close the income statement out into. So that means that if you're working from a trial balance, this number, which would be equivalent to retained earnings if it was a corporation, is really the beginning equity. And that's where you could have problems because the beginning equity might have other things in it, such as the draws. Sometimes people post that directly to the equity account, and sometimes the investments get posted directly to the equity account. And sometimes the prior balances from the prior accounting system get messed up because people delete checks or delete transactions that mess up the income statement from the prior year that messes up the beginning equity balance. So what we need to do then is say, okay, well, if this beginning equity balance is correct, then I should be able to take the equity balance plus the net income and then the draws. All of this should be equity netted out, and that comes out to 153.24, which should be the plug that we need, right? It should be equals the sum of all of the blue. I'm going to combine it in one number, and then we'll break it out into an income statement and a statement of equity for more detail. So there's the 150, and I'm not in balance here. So que paso. So now I'm at here. I'm out of balance by I'm in balance. This minus this, I'm in balance. All right, that makes sense. All right, so now so that has to kind of work, but the problem still could arise that this equity account here had something that was deleted in the prior year or something like that, which you would see in the statement of equity when we roll over prior year's equity to the current year. So now we got to add, let's add the income statement. So let's go ahead and hide this for now. I'm going to make a skinny. I'm going to select this one, Home tab, Format Painter, make a skinny DW, and then I'll hide from here to this one, right click and hide, so that now we can make our income statement over here. So I'm going to say this is going to be an income statement. You might hear it called the statement of profit and loss. This is the timing statement, the activity, the performance statement. How did we do in the last month in our case? Revenue is going to be the first category typically. Could call it income possibly, but revenue is kind of like the more formal name. We have a couple revenue accounts. Revenue sales is going to be equal to that. I'll copy that down to the service. Now, normally we don't have a whole lot of revenue accounts for most types of businesses because we do one thing categorize wise with revenue. We don't want a separate revenue account, by the way, for every customer. That would be tedious. We have a subledger to do that. Don't want to do that. That'll make an ugly income statement. We don't want a separate revenue account for every thing that we sell or service that we provide. That would be tedious as well. Every single different guitar we sell, we don't want in a different revenue account, but we might want large categories of we have service items versus revenue versus income items, for example, as we have here. Let's indent here. So we said it's a colon. That means it's going to have a subcategory, and I'm also going to represent that with an indentation. And then we'll have total revenue. Total revenue is going to be outside equals the sum of these two. We'll double indent, home tab, alignment, double indent, underline here, underline. All right, and then we're going to have the cost of goods sold, which is going to be here. If you sell inventory, this is going to be one of the most important numbers. I'm going to put that directly under the total revenue to have another subcategory here. I'm going to say negative instead of equal because I put all of the expenses as negative numbers. I don't want to represent them as negative numbers on the income statement, but rather use one minus the other, a formula, because we know the expenses should be subtracted. I'm not going to put all the expenses in as negatives. I'm just going to subtract them. And then we typically have a subtotal called gross profit. This would only be the case if you sell inventory, because inventory is such an important part of a company that sells inventory that we enter another subtotal. Now note, by the way, the income statement is often the longest, most complex looking statement if you have a complex company. But if you break it down to its most simple components, it's really just revenue minus expenses, right? It's revenue minus expenses. And then you might have a bunch of sub stops or like pit stops on the way. So you're starting at revenue, you're adding up revenue, and then at the end of the day, you're going to get net income, which is revenue minus all of the expenses. But as you go down to that net income, you might want to have subtotals, pit stops that give you more detail about the income statement. A big one being if you have inventory, gross profit, But then you also might break out between operating expenses and administrative expenses, for example, or you might have other subcategories that you have, along the way as you go down the income statement, which could make it long and complex looking, but also giving you more information. But the general format that we want to keep in mind is it's pretty basic. It's just going to be what we earned minus all the expenses that we had to incur in order to earn it. Right? So the gross profit is going to be a pit stop along the way, revenue minus cost of goods sold. Let's put an underline here. And then we have other operating expenses. So these are, I'm just going to put all the other expenses here, which are like period costs, right? Or the normal kind of expenses for both inventory, businesses that have inventory as well as those that don't are going to have most of these kind of expenses, right? So operating expenses, I'm just going to copy this down to utilities, all right? And then once again, I'll say negative to flip the sign, negative of that insurance. Now, we might not want to add like zero balances on our formal financial statement, but I'm going to add them just to show that we're pulling in all of the numbers from our trial balance here so they all fit, and it's also kind of the easiest thing to do formatting wise as we copy down the information. All right, let's go. We have a colon. That means it's going to be a subcategory, home tab, alignment, indent, and then we're going to have total other operating expenses. Putting this in the outer column equals the sum of the outer column. We'll put an underline here for formatting's sake. And then, that'll get us down to the bottom line number. What's the bottom line? Net income is the bottom line. And so we'll subtract this out. This is going to be, notice I'm not going to be bouncing into the inner column here. I'm in the outer column. I'm just going to work in the outer column. This is the last subtotal we had, which I could have put out here if I wanted to be more formal with my columns, but I want to keep it a little bit tighter. So we're going to have this minus this is going to be our net income of 7,428. I could double check that by selecting the income accounts, revenue minus expenses, the positives minus the negatives. If it was in debits and credit formats, I would make the credits negative and the debits positive, but it would still come out to a net of the 7,428. So let's put an underline here, let's put a double underline here for formatting's sake. And then let's put some blue borders around the whole thing. We'll select the whole thing, home tab, font group, dropping it down, the blue borders, and then I'll put borders around that. And let's make the header black and white. And that's our header, doot. All right, now we have one more statement that we need to deal with in order to tie out the equity, because the income statement, notice what we have here. We've accounted for on our financial statements all of these numbers and then all of these numbers. And then we accounted for these bit kind of, but we summed it together. We don't have really a reconciliation of all of these, breaking out all of these numbers, and then these numbers. And so what we need to do is break out this beginning number, which is prior year's equity, to the current year activity, which includes the income statement as well as any draws or investments we put in the business. So that's going to be a statement of equity. If it was a sole proprietorship, maybe owner's equity like we have here. If it was a partnership equity, which gets more confusing because then you have to break out the equity per partner. There might be 5 partners with different equity accounts. And then equity for a corporation, which is actually easier than a partnership typically, because that's why we have corporations, because it breaks out the ownership not by tracking different equity accounts, but by having equal investment on a per share basis and the number of share then allocating how much ownership should be allocated to each. All right, so we're going to format paint this one over here. I'm just going to call it generically statement of equity. So you might think, like it gets confusing when you go from a corporation to a partnership to a sole proprietorship, but in total, it's the same concept, right? It's the same idea. So let me show you what I mean. We're going to have the beginning balance. Let's make this black and white. And then we have the beginning equity. Now the beginning equity should be, let's put this in this outer column, make this a little wider. It should be on the trial balance, this number. That's the beginning equity. Even though I would run the trial balance as of the end of the month, the trial balance, if you had a trial balance, would still show this number. If you ran a balance sheet as of the end of the month, it would show the combination of this and all of the income statement accounts, because the software would close it out automatically, possibly, right? So this is the key. Now, this number, in order to work, should tie out to the prior year ending equity. So the ending equity in the prior year should be this. What if it's not? Well, if it's not, then you probably have to fix something, meaning you got to go back to the prior year. They probably deleted something. They messed up their income statement. So in other words, like if you already expensed an expense last year and you wrote it off on the tax return, and then it rolled into equity, and then they voided a bunch of checks that you had already written off, well, from a tax perspective, you already got a deduction from it. You already got an expense. So you'd have to adjust for that. Otherwise, the IRS is gonna say, hey, you messed up because you got a deduction for these things that didn't really happen and you didn't reverse it, right? So instead of fixing last year's tax return for those adjustments, you're gonna have to basically fix the current year, right? You're gonna have to adjust it, in essence, in the current year income statement, typically, to then get your beginning balance correct and justify that by saying, hey, look, I compared the net income last year to the net income this year. I saw what the differences were. They're due to deleting a bunch of checks or whatever they did to the prior year thing. So I had to make this adjusting entry, hitting the current income statement typically in order to make the beginning balance correct, so that we're starting from the same place. All right, so then we have the change in equity, colon. So the change in equity is going to be equal to draws, which we don't have any now. If it was a corporation, draws would be called what? They'd be called dividends, the amount of earnings that have been given back to the owner. And we expect that to be somewhat consistent going forward once we start generating revenue. Owner investment, what would that be if it was a corporation? That would be the common stock. The issuance of the common stock is the owner putting money into the business in return for their ownership shares in the business, which is a little confusing because a lot of people buy stock not from the initial offering of the company, but on the secondary market. So, but we have to keep in mind that the equity on the business are the shares sold from the company originally, which are then traded all over the place, possibly. All right, so then we're going to say owner's equity. Wait a sec, that's the difference. And then we have to say net income. Net income, which is the whole income statement, which I could pull from here, or I could say it's going to be equal to the sum of this whole bit on the trial balance. This whole bit here, boom, right, same number. So we're going to say, all right, so then let's indent this, home tab, alignment, indent, and then this is going to be the total change in equity. We'll indent that 2 times, summing it up equals the sum of these items, underline here, home tab, font group, underline, and this is going to be the ending equity. And so then we'll sum this up in the outer column. Boom. Let's put an underline here. Let's put a black and white here. Let's format it for formatting's sake. And we're going to go bordered blue. And that looks good. So now let's unhide the balance sheet. I'm going to go from column DN to DX, right click and unhide. So now we have our balance sheet showing us where we stand at a point in time, assets, liabilities, equity, equity being the book value of the business. The equity should be then tied into the income statement. How? Because the income statement is part of the timing of the equity. We might need, in order to tie the equity in, another report, which is going to be the statement of equity. Noting, however, that in like a QuickBooks, what they'll do is they'll just put the income statement broken out in the equity section of the balance sheet. And then they'll also break out the draws and the investments in the equity section of the balance sheet. So you'll basically have like the whole statement of equity in the equity section of the balance sheet. That is useful because it's easy, and that's why QuickBooks does it, because and so does like a Xero. Most online softwares do that, but it causes problems at the same time, because if you're a partnership, for example, you don't want your net income broken out separately. You're going to have to close the net income into the separate partnership capital accounts. So it looks kind of funny that you have net income in there and then you're going to have to close it out. So it's not, so it's sometimes you can do that in normal reporting. Sometimes it causes problems. The accounting software for small businesses typically does that to try to help people, but it could also cause some issues. So there's pros and cons of that. The traditional way to do that, if there's more complications than just the net income, is to say, I'm going to break it out in a separate form, tying out the ending balance of last year's equity, which is going to be this 77, which we would see in the last year's financial statements, and then the change in equity, which the major change would be net income. And then the other things that could happen would be that money was taken out in the form of draws, which is going to be a common occurrence for a sole proprietorship if the business is doing well, because we're going to make money, hopefully, from the customers and then take it out to pay our current bills. That would be equivalent to dividends for a corporation. Difference between dividends and draws being that in a corporation, the dividends have to be paid out equally per share and are determined in a more bureaucratic kind of fashion, because the corporation has to determine board of directors and management. Whereas sole proprietorship, you can pull out whatever you want. Similarly, with a partnership, you could pull out what you want within the bounds of the partnership agreement. And then you could have, again, investments, which should only happen when you start the business typically, or expand the business, which would be equivalent to the company issuing stocks, capital stock, in a corporation. Now notice that the net income account will close out automatically in accounting software like a QuickBooks or a Xero, so that next year we'll have nothing in net income and we could start fresh. But the draws and investment accounts will not close out automatically. And if we don't close out draws and investments manually as part of the closing process, which we'll talk about next time, I believe, then what you're going to end up with is lifetime draws and investments, which isn't the end of the world if you don't do that, but you have to recognize that, right? So typically, normally, under accounting principles, we would close out not only net income, but also the draws or dividends and the investments for sole proprietorship into like the owner's equity account. So we'll talk about that next time. But the things that we can tie out to see if this is working is we say, all right, assets equal liabilities plus equity. This equity should tie out to the statement. This equity should tie out to the statement of equity right here. And the statement of equity should include net income in the statement of equity. So these two numbers should tie out. And then, of course, this beginning number in the statement of equity should tie out to last year's ending balance in the statement of equity, which, if you're doing taxes, might also be on the tax return if you're doing corporate taxes in the United States. Remembering that sole proprietorships often don't have the balance sheet on the tax return. And because they don't have that requirement, it's much more likely that they're kind of messing up their books a bit, right? Because you don't have the double entry accounting system, isn't actually checking it, even if they're using QuickBooks. Like I say, they could have deleted prior year transactions and whatnot and messed up the income statement, messed up the beginning balance equity, which messes up the timing of the deductions, right? So that's something just to be aware of if you're doing taxes or bookkeeping. The question is, how much double checking can you do for the client? Oftentimes that's within reason, and that can help them be a little bit more accurate possibly with their at least their taxes, if that's what they are using the financials for.